The next on our list, we have Theta. So Theta measures time decay because options have a set expiration date. So the further dated the option is, the more value the option should have because there's a longer time for the option to actually hit the strike price. So let's take a look at an example. You look at Theta here, you'll notice how it's negative for both puts and for calls. Theta is bad for option buyers because this means your option is losing this much value every single day based on the strike price. And similarly with calls. So if you own the option, it means every single day that passes, you're losing 0.165, assuming all else equal. We're looking at July 22nd right now. Let's go all the way out to December 15, 2023. You'll note the Theta is actually very, very low, as in there's so much time until expiration that your option's actually not losing that much value. But Theta actually speeds up significantly within the 45 days to expiration mark. So you'll notice right here, Theta's negative 0.165. Now if we bring it to June 29th, for example, you'll notice how it's steeper. It loses 0.274 of its value every single day compared to July 22nd, we're looking at 0.16. So it's losing almost double the value the closer it is to expiration. So this is very important because Theta is actually our play here. As option sellers, this is how we make our money because of time decay. So we're going to take a look at a quick example from a third-party website. This is the Theta time decay chart. You'll notice how Theta is steepest during the last 30 days to expiration. 60 days, Theta doesn't lose as much. 90 days loses even less. Anything more than 120 doesn't lose as much either. So as option sellers, the sweet spot's right around this area, around the 30 to 45 days. Because if you hold it just for a week or two, Theta, it's going to accelerate, and that means these options are losing value more and more. That means we can buy to close at a lower price, thus locking in our profit. So Theta is incredible for option sellers. If you're an option buyer, you would hate Theta because it means your option is losing value even if you get the direction right. So if you're buying options, you want to aim to have a longer dated expiration. If you're selling options, you should try to go shorter dated. Now using real world example, again, if you're selling options, you should try to go around 45 days out. So probably in the July 22nd range-ish. However, if you're buying options, you should go a little bit further out, September, October range. And that way Theta will have a less impact on your overall portfolio. So what we have here is Theta time decay chart. So this is for out of the money options, and this is for in the money options. As it gets closer and closer to expiration, you'll notice 0 right here is expiration date. You'll notice the time value of the option decreases for out of the money options. As for if it's in the money, you'll notice it decreases almost linearly because the option doesn't really have much time value. Time value is also known as extrinsic value. And so when an option is in the money, it only has intrinsic value. So Theta doesn't decay as aggressively. So our goal as option sellers is to be in this out of the money area, sell options around the 30 to 45 days to expiration mark so we can capture the most in this Theta decay. So a sweet spot for options traders is between 30 to 45 days to expiration, because in that way we could capitalize on this Theta decay. Great, I'll see you in the next video.